Let me take this opportunity to welcome you to our today's session. Today we are doing financial analysis and forecasting. And this is what I told you earlier on to analyze, and you go through the notes. But all of these refer to the evaluation of the financial statements of the company to determine whether the firm is operating effectively or not. So the users of the statements include the shareholders, creditors, employees, suppliers, government, and community. There's a question somewhere in financial accounting where you normally asked about the users of the financial statements. And the same already, we are carrying it up to this point. So two methods are available for evaluating the performance of the firm. One, we normally do the ratio analysis. Two, we have to be looking on the financial forecasting. For those who did the management accounting earlier on, they came across the cash budgets. And then I will be able to go through the percentage of the sales method later on. So let me first look on the ratio analysis. And it normally refers to a relationship between two accounting figures expressed mathematically. So I have said down there, the process of the ratio analysis involves one, computation of the ratio. Two, computation of the computer ratio with some set standards. Three, we have the interpretation, which is very key, of the ratios. So the standards of the comparison, one, we normally look on the past ratio, that is, ratio computed from the first financial statements of the same firm. Basically, we want to measure the performance. Secondly, we have to be looking on the industry average ratios, and that is, we look on the ratios computed from the financial statements on an average firm in the industry. Three, we normally look on the forecasted ratios, and these are the ratios computed from the forecasted pro forma financial statements of the same firm. Then the last one, we have the ratios of some specific firms in the industry, especially the best performing firms. The expression of the ratios, they can be, number one, expressed as percentages. And to express this percentage, we say the ratio, for example, the ratio of the gross profit to sales, that is the gross profit margin, can be expressed at 15%. And that it means is the gross profit is 15% of the sales generated. When we look on the rates, when we express them as rates, we say the ratio of inventory turnover can be expressed as 6 times. That is, on average, the company was able to convert its inventory into sales 6 times. And that is the thing that we just need to understand the ratios. The last one we are talking as pure ratios, e.g., the ratio of current assets to current liabilities. That is, we normally call it the current ratio, can be expressed as 2:1. And that is why we said we just need to be looking on our current assets that we have, whether they can be able to cover the current liabilities of the organization. And we say that the stable ratio, current ratio, it should be 2:1. Don't tell me what you have gotten is 1:1. I'm very aware that the best performing organization, the good performing organization, the least we can have for current ratio should be 2:1. The type of ratios, we normally have 5. One, we have liquidity ratios. 2, profitability ratios. 3, we normally have efficiency, activity, turnover ratios. 4, we have gearing ratios. And then we have the stock market ratios. Let me just go quickly through all of them. I start with the liquidity ratios, and I say these ratios are used to measure the firm's ability to pay current liabilities. I just want to repeat again. They are the ratios which are basically used to show the firm's ability to pay its current liabilities. And they measure the liquidity position of the firm by comparing its current assets with the current liabilities. So they are the liquidity ratio, the better the company is. And they are normally expressed as pure ratios. That is the liquidity, pure ratios, right? So let's start with the formula for the current ratio is where we normally compare our current assets with current liabilities. And the most important thing that we are trying to look is that it is the main liquidity ratio. It should not be the ratio, but ratio. We show that the number of times the firm's current assets can cover the current liabilities. And that is why I say the ideal current ratio should be 2:1. Secondly, we normally have the quick ratios, and that is When we discuss about the quick ratio, we are trying to look on our assets, which can be quickly converted to liabilities. And the reason there is a deduction of the inventory because it is not considered as a part of the, it is not considered to be quickly be converted into converted into cash. Now, the current ratio, we normally look on the cash in hands and at bank. We divide with the current liabilities, and the most important, it is an extremely measure of firm's ability to pay its current liabilities using its current level of cash and cash equivalents. We normally have internal measures where we normally look on we normally take our current assets and we divide with daily operating costs. To get your daily operating cost, you just need to take the annual operating cost to divide by the number of days. It is not a must that you are given 365 days. No, examiner might even give you less days. And that is why it shows the firm's, the number of times the firm operating expenses can be converted into current liability on a daily basis. The second type of ratio, we have the profitability ratios. And these ratios are used to measure the firm's ability to generate profit out of their current level of operations. And most importantly, they are mostly expressed as a percentage, and the higher the profitability ratios, the more the profitable the firm is. They normally include, one, we normally have the return on capital employed, ROCE, and the return on the capital employed, we have to be taking the profit before interest and taxes. That is an operating profit or operating profit. We divide by the capital employed. And where the capital employed is the total of the long-term funds for the organization or for the firm. That is a common equity capital, preferred share capital, and then we have the long-term debt. And our equity, we are saying that it is normally comprised of the ordinary share capital and reserves. The reserves, we might be having the share premium, which are normally called the capital reserves. And also we have the revenue reserves, which are basically attained through the retained earnings. Now, it is the main profitability ratio, which measures the firm's ability to generate profit out of its current investments in long-term funds. We also look on the return on investment, and this is what majority of us normally, this is the name we normally use when we do our investments. And we are saying that during this time, when we have the return on investment, we normally take the profit after tax. We take the profit after tax, we divide by the total assets. Then we multiply by 100%. Remember, all of these are percentages. And we have said the return on investment, because we just want to see the performance of the organization, it is good to be showing the firm's ability to generate profit out of each of investments made in the current assets and non-current assets. Now, when you look on the return on total shareholders' funds, we have to be looking on the two aspects. We have to be taking our profit after tax, we divide by the preferred share capital together with the equity. And the most thing that we are checking there, it basically, we just need to be looking the firm's ability to be able to generate profit of each investment which they are made through the shareholders' funds. We have the return on equity, and we have to be taking the profit after tax and preferred dividends. We divide by equity, we multiply by 100. And I have said it to compare the profit attributable to ordinary shareholders with the common equity capital as a measure of the firm's ability to sustain the current level of profit using the common shareholders' funds. We also have the operating expense ratios, where we have to be combining our operating cost together with the cost of sales. We divide by the sales, we multiply by 100%. And this basically measures the firm's ability to minimize these operating expenses while still generating a given amount of sales revenue. This one is the most tested, the profitability. It is a bit tested. You will be able to see that these ratios are commonly, they are commonly asked in the questions when the questions of the ratios are being tested. So it's very important to be keen on that. The other one, the other type of ratio, we discuss about the efficiency or turnover ratios. And we are saying that they measure the degree of efficiency in a firm when managing its current assets and current liabilities. And we are saying that they are used to measure the firm's ability to effectively manage the investment in assets and liabilities. So in that case, we are saying that let us just look for inventory turnover. And basically the inventory, the other name is just the stock turnover. We basically take the cost of sales, we divide by the average inventory given in times. And the average inventory, we have to be taking the opening and closing, divide by 2. And we have said it measures on the average, the frequency by which the firm was able to convert its inventory into sales. And the number of times the firm was able to buy and sell its inventory during the year. So the higher the turnover, the more efficient the firm is. Secondly, we have the inventory holding periods in days. We take 365, we divide by the inventory turnover. And most importantly, the most common formula we normally use, it is the 365 days. Because you see, the inventory turnover, the formula that we normally use, we normally take, and I was able to introduce to you here, we normally take the cost of sales over the average inventory. Here, because already the inventory is on the denominator side, you have to reciprocate your formula. So that is where we have reciprocated. You get the average inventory up, you multiply, or you divide by the cost of sales, and you are giving it in days. And it shows an average the duration taken by the firm to hold inventory in stores before selling it to customers. So the lower the duration, the more efficient the firm is. We also look on the receivables and the debtors turnover. We are saying that it is very important when you take your annual credit sales, you divide by the average debtors. We are already to say there, it measures the number of times that the firm's credit customers were able to pay their debts during the year. So the higher the turnover, the more efficient the firm is. The other one, we have the receivables period, the average collection period, and these are the ways the organizations basically tries to come up with a formula for the computations of the credit period that administered to customers. So the receivables period, we are taking 365, we divide by receivable turnover, or we take 365, we multiply by the average receivables, we divide by the annual credit sales given in days. And it shows the credit period offered to the firm's customers. So the shorter the period, the better for the firm, because it will be able to get back the resources as early as it could. So in that case, it means that the shorter the period, the better for the organization. The payable turnover, now it comes to us where we are supposed to be dealing with our suppliers. And the same normally applies where we have to take our annual credit purchases, we divide by the average creditors given in times. So the lower the duration, the better for the firm, because we are not going to be having more debts being owed. Now, the payables period, we have to be taking the 365, we divide by the payables turnover. Commonly, we normally use 365. Then the average creditors, you divide by the annual credit purchases. So when you are doing these receivables and payables, you normally divide by the annual credit sales. We also look on the payables, we normally divide by the purchases. Basically, because on the side of receivable, you are dealing with the customers. Here you are dealing with the suppliers, and that is why we put that is why we normally divide with purchases there. We normally have the total asset turnover, where we normally take the sales, we divide by the total assets, and it shows the number of times that the current level of sales can cover its investment in total assets. So the higher, the better for the organization. So the fixed asset turnover, we take our sales, we divide by the fixed assets given in times. We have the capital employment turnover, where we normally take our sales, we divide by the capital employed, given also in times. The other one, we have equity turnover. We normally take sales, you divide by equity, again, given in times. We have to be looking on the next type of ratio, where we have to be checking on the gearing ratios. Also, we look on the leverage ratios. And we are saying it is not too good, but they are used to measure the gearing risk of the organization. So these are the risks which are basically associated with the use of the debt finance in the capital structure. That is the thing now we covered in our previous classes. They measure the extent to which the firm is financed by owners of equity as well as borrowed funds. So the other ratio, the higher the risk, and they include, the first one is the debt ratio, where we normally take the total liabilities, you divide by the total assets, you multiply by 100 there. the interpretation we are saying to compare the firm's liability with these total assets as a measure of how safe the firm is regard to payment of debts. Basically, you have heard about the aspects of debt ceiling, among other terms, basically used for the interpretation of debt in the National Treasury. But in that case, it means that we need to be looking on how the safe the country is in regards to exposure to more debt, compared to equivalent to the GDP. So that is why we are saying we have to be looking how safe we are in terms of the exposure in debts. Let's look on the gearing ratio. We normally take the long-term debt plus preference share capital. We divide by our capital employed. Earlier on, I was able to explain about the capital employed. The debt to equity ratio, we take the long-term debt, we divide by equity. Equity multiplier, you normally take the total assets, you divide by equity. You give it in times, and it is the firm's ability to recover the investment in equity from its current level of total assets. So the higher the ratio, the better. Then we have the interest cover, where you normally take the operating profits to divide by interest given in times. And the interpretation, it normally shows the number of times that the firm can pay its interest, so financial cost out of the current level of operating profits. So they are the better. Let me look for the last one. No, that was the last one. The stock markets, we shall cover it later. I just want to go quickly and look for illustrations for ratios. I will be able to start with a question here in 2018. We start with May 2018. That is question number 5C. Question number 5C. Someone to read for us. Kindly. Someone? There is not anyone. Let's start with Sheila.
Province Express Limited records got lost in a fire that burnt down the accounts office. The following information was, however, obtained from the laptop of the accountant for the year ended 31st December 2017. Opening stock 450,000. Stock turnover ratio 10 times. Net profit margin 15%. Gross profit margin 20%. Current ratio is 4:1. Long-term loan 1 million. Depreciation on fixed assets rated 10% at 100,000. Closing stock 510,000. Additional information. Number 1, credit period allowed by suppliers in 1 month. Average debt collection period is 2 months. On 31st December 2017, current assets consisted of stock, debtors, and cash only. There was no bank overdraft. All purchases are made on credit. Cash sales were 1/4 of total sales. Acquired cost of sales, gross profit, total sales, total purchases, net profit, debtors value, creditors value.
Thank you so much. When you look on the kind of questions given, it means you need to have understanding of ratios so that you can be able to see what is being given and what is the requirements of the question. For example, when I look on the first requirement, examiner is asking us about the cost of sales. And as a student, you might be asking yourself, what should I do to get this question right? And that means I need to be understanding the formula for getting the stock turnover ratio. And when you look on your notes very well, because you just need to master your formulas. It means we say to get our stock turnover ratio, stock turnover ratios, we normally take the cost of sales, we divide by average stock. Let me just use the average stock. Now, in this case, when I look on the requirement given in the question here, I'll be able to find that examiner has given me up there, has given me the stock turnover ratio of 10 times. So it will be 10 is equals to the cost of sales. I don't know, but I have the average stock. How can I be able to get the average stock? Through taking your opening stock, right? Remember we said you have this one to be taking your opening stock plus closing stock. We divide by what? We divide by 2. That is what I just want to put directly here. Yeah? So my opening stock is 450,000. The closing stock of mine is 510,000. This one, let me divide it by 2. So how much am I getting here? What is my answer? How much are we getting there? Someone to give the answer? So it means I just need to take 450,000 plus 510,000 divided by 2, getting 480,000. So it will be 10 is equal to the cost of sales divided by 480,000. So the cost of sales of mine will be 10 times 480,000, getting how much in Kenya shillings? 4.8 million. 4.8 million, right? I have already covered my first requirement. When I go to number 2, when I go to the requirement number 2, I'll be able to find the examiner is asking us for the gross profits. We'll be able to ask for the gross profits. To get my gross profits, right? To get my gross profits, there are only 2 ways in which I'm supposed to be doing by thinking, right? To get my gross profit margin, which is already provided in the question, get my gross profit margin. We normally take your gross profits. We divide by our sales. But when I look on the questions, on the question provided, I'm not given sales. What am I given by the examiner here? I have seen an examiner giving you because already we have computed our cost of sales, right? We have already computed our cost of sales. Is it possible if, for example, I say, because I don't have sales, but I have computed the cost of sales, I can convert my margin to markup, right? And then I use this formula to get your gross profit markup. You normally take your gross profits, we divide by cost of sales, which we have already computed here. So in that case, the gross profit markup, you're going to be getting it by doing what? I will just be taking my gross profits, converting it to fraction. And this I see it is 1/5. To get my markup here, you normally take the numerator, you subtract from the denominator. I think that is what you'll be doing in FR. And this translates to around 25%. That one translates to 25%. So in that case, I will be able to say 25% which is my gross profit markup now, should be equal to the gross profit, which I don't know, but I divided by the cost of sales, which I was able to get as 4.8 million. What is my gross profits? I just take 25%, we multiply by 4.8 million. How much in Kenya shillings? So it will be 0.25 times 4.8 thousands, getting around 1.2 million. That is my gross profits. That is my gross profits. That is my gross profits. When you go to number 3, there is a requirement there where the examiner is asking us to compute the sales. And that one I will not be able to strain a lot because I know because already I know very well to get our gross profits. Let me start from that point. To get my gross profits, I normally take my sales minus cost of sales. The gross profit already I have it here, which is 1.2 million. Is equal to sales, which we don't know, minus our cost of sales. I remember it was 4.8 million. Remember here, there is no even a formula you're using. Here we just use the common sales. So to get my sales, it will be 1.2 million plus 4.8. So how much are you getting here in Kenya shillings? Should be 6 million. Should be 6 million there. Now from there, we look on the requirement number 4, where the examiner is asking you for the total purchases. And these ones, we just need to use common sense here, purchases. Because to get your cost of sales, you normally take the opening stock plus purchases minus closing stock. Minus the closing stock. What is my opening stock? We say, my opening stock, I remember here, I said it is 450,000. Do I have the purchase? No. But the closing stock of ours is 510. These we are supposed to equate with 4.8 million. Because it's your cost of sales. Now, to get your purchases now, take the lifetime together, and I will take 4.8 million. Plus, remember this is negative. When it goes on the other side, become positive. 510,000 minus the 450. So what is my purchase now? It will be 4.8 million plus 510,000 minus 450. And you remember we are getting Kenya shillings as our purchases, 4860, 4,860,000. Those are my purchases. Those are my purchases. Now, the other one, number 5, they're asking us about the net profits. You are being asked about the net profits. And we say, to get my net profits here, get my net profits, I will remember that to get my net profit margin, which is already in the question, net profit margin. The net profit margin, we normally get it by taking the net profits. We divide by sales. Because now we have the sales, we are on a better side. Now, what is the net profit margin? What is my net profit margin from the question? What is my net profit margin? I will say, the net profit margin provided in the question is given how much? The net profit margin is 15%. So I say, let me take 15%, which you normally take the net profit, which you don't know. We divide by the sales, which you are able to compute, which is 6 million. So what is my net profit? I say, I take 15% of 6 million. So how much it is? So 0.15 times 6 million, getting 900,000 as my net profit margin. As the net profit margin. The second last, we are being asked about, a minute, please, 1 minute. Now, I just want us now to look on the data's value, right? The data's value, that is, I think, number 6. Number 6, the data's value, just look on the payables, right? What is our payables, receivables period. Receivables periods. We look on the period given by these examiners, right? Now, remember, on our formulas, we were discussing about the days, but here they have given you in months. So to write your formula for the receivables period, I will take the number of months in a year, which is 12, times average receivables. We divide by the annual credit sales. Now, how much is the receivables period provided there? When you look on the additional information, right? Additional information 1, not number 1, but 2, we are being told the average debt collection period is 2 months. So I will take 2 is equals to 12 times average receivable. Then we divide by the annual credit sales, And when you look on the last point, the last additional information we are being told, the cash sales were a quarter of the total sales. A quarter of the total sales. It will be a quarter. Now, the cash was a quarter. It means the credit sales were 3/4. 3/4 you multiply by how much was our total sales? How much was our total sales? And you see, your total sales was 6 million. The total sales was 6 million. So in this case, it means I just need to take 2 times 3/4 times 6 million, which is equal to 12 average receivables. Okay, so 2 times 3 divided by 4, right? 2 times 3 divided by 4, which is 1.5 times 6 million, getting 9 million here, should be equal to 12 AR. Divide here by 12, divide here by 12. So the average receivables is how much? The average receivable should be equal to 9 million divided by 12. I'm supposed to be getting Kenya shillings, 750,000. 750,000. That is how you compute your average receivables. Then let me calculate the last requirement of the question. The last requirements. The examiner wants us to compute what? We have been told we need to get the payables. That is they are asking about the payables periods. And we have said we take the months, we multiply by the average creditors, then we divide by the annual credit purchases. The average credit purchases. So the payables period is given under the additional information number 1. The credit period, the credit allowed by the suppliers is 1 month. So I just take 1 month. 1 is equals to 12 times average creditor. Then the annual credit sales. I see in note number 5 addition, All the purchases are made on credit. But how much was our purchases? We were able to compute them and we got 48,60,000. So the average credit of viewers should be 4860 divided by 12. So how much is the average credit service? So in this case, it's 4860,000. We divide by 12, getting Kenya shillings 4,500. 4 or 5,000. That is how you get your creditors periods. That is how you get your the average creditors that is asked by the examiner. Allow me to do another illustration. I just do an illustration which was tested on we look on May 2016, question 3A. May 2016, question 3A. May 2016, question 3A. May 2016, question 3A. So let me go there, right? May 2016 now. Okay. Who's reading for us now? Let me just open it. May 2016, we have question 3A. Very good. Who is in? Marion, can you read for us?
Extracted from financial statements of Jaribuni Limited for the year 31st December 2015. Cash equivalent assets in credit, net current liabilities, notes payable, debtors collection, return on equity. Assume 365 days in a year. You're required to get account receivables, current assets, return on total equity, and quick ratio.
Thank you so much. Eventually, when you come across these questions, just look on the area the questions are coming from, whether it is from the profitability ratio, whether we are dealing with there is a profitability ratio, whether we are dealing with the liquidity. It is very important to be able to know where the questions are being set from. Now, the first one, the examiner wants us to get the account receivable. And in that case, I just need to go back to look on the receivables periods so that I can be able to get the account receivable. That is what we have just been doing in a few minutes ago. So to get the debtors, let me just use the debtors collection periods. It is the same thing. Debtors collection periods. Debtors collection periods. We are going now to be taking 365. I have seen examiner giving updates times average receivables. You divide it by the annual credit sales, right? Now, the debtors collection period as per the question is how much? When I look on that question, I will be able to find that the debtors collection period we have been given 40.55 days. We should be equal to 365 AR. You divide it by, we are looking on the annual credit sales. And when I look at it here, our sales, we have already been told they are on credit. So I divide by 2,000. So It means I take 40.55 times 2000, which is equal to 365 AR. Divide here by 365, divide here by 365. How much is my account receivable? Account receivable is how much? So in this case, I will be able to take account receivable. You take what? I will be able to take 40.55 times 2000. Then I divide by 365 days. I'm getting you're getting, remember they are in millions, right? So Kenya shillings, 222.19 million. 0.19 million. The other one, we go to number 2. What is the requirement number 2? The examiner is asking you about the current assets. Right? So when I look on the current asset formula that we were able to talk about earlier on, I can see we are being given current ratio. And how do we normally get the current ratio? We normally take the current assets, we divide by current liabilities. So because we are assessing the current assets, don't say, Malimu, we are using 3:1. That is a ratio of 3:1. You can see it is 3:1, correct? So it means when you are equating up here for the ratio, you are saying it is 3. If we were looking for the current liabilities, the one that we are supposed to be equating will be 1. So in this case, the current asset is the one that we are looking for, right? Which is 3 times the current liabilities. How much is your current liabilities? The current liabilities of ours, we are being given how much? I can see we are being given around 211. 211 here. So I know very well that my current assets will be equal to 3 times 211, getting 633 million. Number 3, we have what? We have the return on total assets. The return on total assets. So when the examiner is asking you to get the return on total assets, we said this is our ROI, the return on investments, which you normally get it by taking the profit after tax, which you can examiner can call it net income. We divide it by, we are dividing it with the total assets. What is my net income here? What is my net income? When I look on that question, I can see somewhere, given the net income of 100, how much is our total assets? How much is our total assets? I remember you have a current assets of 633. We should add what? Do we have any other assets existing in the question? Any other asset in the question? And I will say yes, because already you are being given the fixed of 567. You are given a fixed assets of 567. Then in this case, I'm in position to get the total assets. So 633 plus 567, that is 1200. So it will be 100 divided by 1200. How much it is? And remember, you are converting it into 100%. So 100 divided by 1200. 100 times 1200 times 100%. I should be getting something closer to 8.33%. That is the return on investments. The return on investments. That is what you're supposed to be getting. What is the other requirement as per the question? Let's look here. The next requirement I can see, examiner is asking you to compute equity, right? And when I look on the requirement provided, I will be able to remember the return on equity, that is number 4. The formula for the return on equity I'm supposed to be taking the profit after tax and preference dividends. We divide by equity. So there must be, an examiner must already given you the return on equity. I can see it is 12%. 12%, which is equal to the profit after tax and preferred dividends. How much do we have there? The profit after tax that we have, it is 100. We cannot be able to compute anything beyond that. Then you divide by your equity. Now, it means 0.12 equity should be equal to 100, divided by 0.12, divided by 0.12. How much is our equity? How much is our equity? 100 divided by 0.12. I should be getting around 833 million. 833 million. Then the last one. The last one, examiner is asking you about the quick ratio. And we said, we normally take the current assets minus the inventory. You divide by the current liability. But you will not be able to tell me, Mwalimu, are we using the 633 million? I will say no. Reason being, these current assets already have inventory. And that is why the inventory is normally subtracted. We say it is normally subtracted because it is not regarded as an asset which can quickly be converted into cash. So already under the current asset, the inventory is included, and we don't know how much was inventory. So what should we do? I will be able to look on the questions and look on the other assets which form the current assets, and I will be able to say there is a cash and cash equivalent somewhere. Cash and cash equivalents, we have been given, that is a current asset of 200 million. That is 200 million plus, right? When I look again on the same note, I will be able to see, there is an area we calculated, by the way. The account receivables of ours is 222.19. Then don't ask me, Mwalimu, why are we not, because the difference which is existing between 633 and what we have here should be your inventory. Then we divide by the current liabilities. How much is our current liability? Now, when I look on that requirement, the current liability of ours is 211. So how much is our quick ratio? 200 plus 222.19 divided by 211. And you can see you are getting 2. This means the ratio of yours should be 2:1. And we're saying this is the stable ratio with the under the quick ratio, which you're supposed to be getting. It is an ideal. It's an ideal ratio, which you're supposed to have the minimum, by the way. So from there, allow me to do the last question of the day. Allow me to do the last question. And we call it a day. There is a question there under these periods, April 2022. April 22, there is a question there. Let me just look on which question is it? It should be question number 5C. That is April 2022, question 5C. Question number 5C, 5C. Question 5C. So let us do that question as we wrap up. So April 2022, so that I can give you an assignment. Who is willing to read for us? I have said it is April. It should be the last question. Let me read this one. So the following information relates to Jolop Limited for the financial year ended that 4 December 2021. I can see the examiner giving you the statement or the income statement or the statement of comprehensive income is provided. Down there, I can see the examiner has given us the statement of the financial position. And then he has gone straight to give us or to ask us some questions which we are supposed to answer. One, to compute and interpret the following for Jolop Limited. One, it is the operating profit ratio, right? The operating profit ratio. And in that, I will just be able to leave for you to go and do those interpretations. You can be able to get them. And then from the question, the first thing that I'm supposed to be asking myself is, how do I normally get the operating profit ratio? Number one, the operating profit ratio. The operating profit ratio, the formula that we're supposed to be using is, we normally take the operating profits. You divide by sales. You multiply by 100%. Right? But you will realize that the examiner has not given you the operating profit. So if he has not given you the operating profit, what am I supposed to be doing? I should take my net sales.
Malim,
Yes.
we are still seeing the question.
Sorry for that. Sorry for that. You take your net sales, you subtract the total operating cost. The total operating costs. Now, when you go to the statement, the income statement provided, you will be able to see, when you go to that income statement, there is a net sales. When you take your sales minus the sales return, you'll be able to get the net sales of 195,000. Minus the total operating cost comprises of what? The total operating cost comprises of the cost of sales, which is 125,000, plus the other operating cost we have somewhere, the administrative and distribution expenses amounting to 35,000. In that case, you are getting around 160. So 195,000 minus 160, I should be getting around 35,000. I should be getting that 5,000. Now, to get my operating profit ratio, I'll be able to take my operating profits. I've talked about that 5,000. You divide by how much is your net sales? Let's say my net sales is around 105,000 times 100%. How much it is? How much it is? That 5,000 divided by 105 times 100, I should be getting 17.95%. 17.95%. Number two, what is my second requirement? The second requirement of the question is the net profits to capital employed. We have been told the net profits to capital employed ratio. Now, how are we going to be getting this? It means you just need to be taking your net profits. You take your net profits. You divide by the capital employed. The net profits, you divide by the capital employed. You just multiply by 100%. I've said I'm sending you back to the book so that you can be able to read about the interpretations. So what is the capital employed? We said, let us take our share capital. We add the general reserves. We add retained earnings. So how much is our share capital? How much is our share capital from the question? That is the statement of the financial position. I see somewhere where we are being given the share capital of 500,000, that's the equity share capital, which is 500,000. The general reserves of ours is how much? I can see it's 50. Then the retained earnings are 70. That is 120, 620. So how much is my net profits? How much is my net profits? And when I look on the question given up there, the statement, the income statement, you realize that how much is the net profit? We are given a net profit of 40,000. You divide it by 620,000 times 100%, times 100%. So 40 divided by 620 times 100 is how much? Okay, so 40 divided by 620, you're supposed to be getting something closer to 6.5%. 6.5%. 6.5%. 6.5%. That is how you calculate the net profits to capital employed ratio. We have from that one, we go to the stock turnover ratio, number 3. The stock turnover ratio, we have said, to get my stock turnover ratio, what am I supposed to be using? The stock turnover ratio. I say, to get this stock turnover ratio, let me take the cost of goods, the cost of goods sold, we divide by average inventory. You divide by the average inventory. Ask yourself, what is my average inventory? What is the average inventory? I will go straight to the income statement to capture the openings and closings. So the opening is 3,000. Closing is 5,000. You divide by 2, get into 4,000. Correct? What about the cost of sales? Is how much as per the question? The cost of sales are being given is 125,000. So the stock turnover ratio will be 120. Is it 120 or 125? 125,000. You divide it by 4,000. You divide it by 4,000. How much it is? When you take 125 divided by 4, it should be that 1.25 times. Don't forget to do your interpretations while you are doing your revisions. Very important when you are doing your interpretations. Now, there is an alternative method to calculate this, and you can just go and do it. Or you can take your net sales, you divide by average, you divide by the average inventory. You take your net sales, you divide there by the average inventory, and you see whether you are getting the same answer. No, that is the wrong. This is the wrong, sorry. Let us proceed. We have the requirement number 4. the requirement number 4, where we are discussing about debtors collection periods. How much is our debtors collection period? We said we have to be looking on the days, because if, for example, in my question here, let me do an assumption of days. I will take 365 days times average receivables, you divide by annual credit sales. Annual credit sales. So in this case, I will take my 365 days. I multiply by how much is our receivables from the statement of the financial position. You will find them under the current assets, 50,000. Then you divide it by the annual credit sales of ours. We are going to be using 195,000 because you are not being told the proportions of the cash and credits. So we use the figure that we have. So how much is this? How much is this? So it will be 365 times 50,000 divided by 195,000, getting around 94 days. You are getting there 94 days. Then let us do our last two requirements. Our last two requirements. The first one is we are being asked to calculate the gross profit ratio. That is number 5. Gross profits. The gross profit ratio. The gross profit ratio. Are we getting our gross profit ratio? We say to get my gross profit ratio, we normally take the gross profits. You divide by sales, multiply by 100%. Correct. How much is your gross profits? And this should be the net, by the way. Net sales. So how much is our gross profit here? From the our gross profit is 70,000. You divide by 195,000 times 100%. Times 100%. How much? How much are we getting now? How much are we getting now? And it should be 70 divided by 195 times 100, getting around 35.9. 35.9%. Then the last one is the easiest. We discussed about the quick ratio. And to get our quick ratio, let us take current assets minus inventory. We divide by the current liabilities. Correct. How much is my current assets? How much is my current assets? Where am I supposed to be getting that figure? From the statement of the financial position. So the current of assets we are being given, the total current assets we are given 150,000. How much is my inventory under the same current assets? We are being given 80,000. What about the current liability? The current liability we are being given in which notes? The current liability we are being given somewhere down there. The account payable is the only current liability we have, which is 80,000. So how much is this? What is your ratio now? How much is this? So it will be 150. 150 minus 80 divided by 80. We're supposed to be getting 0.875. 0.875. Now, for your continued revision, let us do an assignment here. For which period? My assignment should be May 2017. May 2017, question number 4A. May 2017, we have question number 4. May 2017, question 4A. It is our assignment of the day. So let us go and do it and see how we will continue doing, how we will transform in terms of understanding, So let us stop at that point. Unless there is any question, we stop at that point. We will be able to continue finalizing on the ratios as we meet on Tuesday. Also, even on Wednesday, we have Mandamano, which we shall be doing one of the classes in the morning. We compensate the period we have lost or this week. We compensate. On Wednesday morning, we continue to have these demos. So let me stop at that point. Let me wish you a good day. See you on Tuesday.
Question, William. Question.
Yes.
I have a question about the last chapter we did on the cost of capital. We only covered the part 1. What about part 2?